Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. We're really glad you could join us today. We're going to dive into a pretty significant recent earnings call. This one's from a major global player in tech and mobility.
That's right.
And our mission, like always, is to cut through, all the jargon. We want to unpack what really matters from their discussion. Think of it as your shortcut to understanding the key stuff.
Yeah, the important takeaways.
Exactly. We'll pull out the surprising bits, the key insights that came up when the analysts were grilling them. So you walk away really knowing what's going on.
And the source material here is, well, it's the transcript of the earnings call itself. It's pretty valuable stuff.
Direct from the source.
Yeah, you get a direct line into what the CEO and CFO are thinking, what they're prioritizing. Plus, you hear the questions from some really sharp analysts.
That's often where the gold is, right? In those Q&A sessions.
Definitely. It really highlights their successes, sure, but also the challenges and, their big picture vision. We'll be covering a lot today, actually. Everything from some really impressive financial results.
Record-breaking, I saw.
Yeah, exactly. Record-breaking performance, all the way through to their tech initiatives like AI and autonomous and their strategies for future growth. There's quite a bit to unpack.
All right, let's jump right in then. The headline news really seemed to be about setting new records this quarter.
It really was, across the board.
They put up some seriously impressive numbers. I mean, top-line growth looked really strong trips, and gross bookings, both climbing, 18% year over year?
18%, yeah. Which, for a company this size, is pretty remarkable. It shows demand is still really robust.
Definitely. But it wasn't just activity, right? Their financial strength hit new peaks, too.
That's the key part.
Yeah, all-time highs in adjusted EBITDA, GAAP operating income, free cash flow, too, I think.
All of them. Record highs. Which tells you a lot about their operational profitability and just core business performance. Free cash flow hitting a record is huge.
It really signals efficiency gains, doesn't it? Not just getting bigger, but getting better at making money from the business.
Exactly. These aren't just small steps up. They're new peak levels of performance. It points to some, fundamental improvements.
And they seem pretty confident looking ahead, too. The outlook for Q3 sounded strong.
Very strong. They're forecasting continued high teens growth for gross bookings.
Okay.
And then even faster growth for EBITDA, low to mid 30% range.
Wow. So they expect that profitability momentum to keep going, maybe even accelerate?
That's the signal, yeah. Lots of confidence that they can keep turning that top-line growth into bottom-line profit.
So these records, they're not just numbers on a page. What does it really tell us about where the company stands?
Well, seeing records across, growth and profitability metrics at the same time, that's significant. It suggests they're not just growing, they're growing more efficiently. They're really solidifying their market position. It means the business model is working and probably getting more refined.
Right. It's profitable growth, not just expansion for its own sake.
Precisely. And you have to connect it back to the user engagement. They mentioned almost 30 billion app visits in the last year.
30 billion. That's staggering.
It is. It shows incredible user stickiness, right?
Yeah.
People are really integrating these services into their daily lives. That level of engagement fuels the growth numbers.
That makes sense.
So when management gives that strong Q3 guidance, it's not just wishful thinking. It's based on seeing these trends, this deep engagement, and believing it's sustainable.
Okay, so a really strong financial foundation laid.
Definitely. Which sets the stage for some other bigger strategic moves.
And speaking of strategic moves, there was a pretty big internal development announced a new chief operating officer, Andrew McDonald.
Yes, that was a key announcement. The CEO sounded genuinely excited about it.
What's the focus for this new COO role?
The main goal, as they put it, is to supercharge the platform strategy.
Supercharge it, right?
And a big part of that is unifying the efforts between mobility, rides, and delivery.
Bringing those two closer together operationally.
Exactly. Historically, they might have operated a bit more independently, maybe optimized for their own specific goals.
Right, different leadership, different priorities sometimes.
Yeah. But now, the leaders for both mobility and delivery report directly to the COO. It's a unified structure.
Interesting. So it's about breaking down silos.
Pretty much. And it goes beyond just rides and delivery. Other big cross-platform things like advertising, which is growing fast, and their autonomous vehicle efforts also fall under his responsibility now.
So a really central integrating role then.
It seems like it, a major organizational shift to create a more cohesive machine.
What problem is this trying to solve, fundamentally? You mentioned silos.
Well, they actually called it a structural problem on the call. The issue was that with separate leadership, teams might focus too much on their own vertical. The mobility team pushes a great feature for riders, but maybe doesn't think about how it could also nudge that rider towards ordering food later.
Or vice versa. Maybe conflicting incentives sometimes?
Potentially. Or just missed opportunities for synergy. With one person overseeing both, the idea is they can push for more aggressive, more joined-up platform promotion.
So designing things that encourage people to use both services.
Exactly. Things like incentives, the app design itself, marketing campaigns, making it feel seamless to hop between ride-hailing and delivery.
That makes sense. It aligns with trying to get more value out of each user, right?
Absolutely. It's about leveraging their whole ecosystem more effectively, not just individual parts, turning it into a real interconnected network.
Okay, that structural change makes a lot of sense then, especially leading into the next big theme, these platform initiatives.
Right.
They really focused on driving deeper engagement across all their services. And they highlighted a pretty stark challenge, didn't they?
They did. The fact that fewer than 1 in 5 consumers actually use both mobility and delivery.
1 in 5. That seems low, given how many people use at least one of their services.
It does, and that's the huge opportunity they see. They have millions and millions of users, but most are just single-service users.
So the big question for them is how to convert those people. Get the ride users to try delivery, and the delivery users to take rides.
Precisely. How do you turn those single business consumers into dual users? Because that's where the real value seems to be unlocked.
What are the actual benefits? Why is a dual user so much more valuable?
The numbers are pretty compelling. They said dual users have a 35% higher retention rate.
Wow. Okay, so they stick around much longer.
Much longer. And even more significant, they generate 3 times the gross bookings and 3 times the profit compared to someone using just one service.
3 times, that's a massive difference.
It really is. It completely changes the economics for that user.
So that explains why they're pushing so hard on this cross-platform stuff.
Absolutely. And it gives them a competitive edge, too, because most of their competitors are mono-in. They only do rides or only do delivery.
Right. So this company can potentially spend more to acquire a customer, knowing they might become a high-value dual user later.
That's the structural advantage. They can market more aggressively, knowing the potential payoff is higher for those dual users.
And how does technology like AI fit into this?
AI is becoming crucial here. They talked about using larger AI models.
Okay.
These models can apparently understand a lot more context from a user's history, their patterns, even seasonality.
So getting much more personalized.
Exactly. Hyper-personalization was the term. The idea is to offer really targeted promotions at just the right moment.
Like what kind of examples?
Well, they mentioned something like the AI noticing your commute pattern and offering you a discount on a coffee order through your app just as you're heading to work.
Ah, okay. So really timely and relevant offers.
Or maybe suggesting grocery delivery after you've just booked a ride home late from the office. Things that add value and naturally encourage trying the other service.
That makes sense. It feels less like random marketing and more like a helpful suggestion.
That's the goal. Using AI to make the cross-platform experience feel intuitive and beneficial.
This talk of integrating services brings up the whole super app question. Are they trying to become one of those platforms like you see in Asia, where you can do literally everything in one app?
It's interesting. They acknowledge that debate. It sounds like an ongoing internal discussion.
So no clear yes or no.
Not exactly. They describe their approach as aiming for the best of both worlds.
Okay, what does that mean in practice?
Well, they pointed out that their main rides app already acts a bit like a super app. It has that prominent delivery tab, right?
Yeah, you can easily switch over.
And apparently that integration is already driving a lot of business. They said about $10 billion in delivery bookings actually originates from the rides app.
10 billion, just from that tab.
Yeah, which is like 12% of their total annualized delivery booking. So it's already working to some extent.
So what's the strategy then, if not a full super app?
It seems they want highly tuned individual apps, one for rides, one for delivery, but apps that talk to each other intelligently.
Wow.
So they can offer those targeted, personalized cross-promotions we just talked about, the ones that add real value. They explicitly said they want to avoid broad, maybe anti-consumer promotions, just blasting everyone with irrelevant offers that might just annoy people.
Right, so less about forcing everything into one interface and more about smart background integration.
Exactly. Making it feel cohesive and helpful, not cluttered or overwhelming. Precision over just jamming everything together.
And how does their membership program, Uber One, fit into this platform strategy?
Uber One is a huge piece of the puzzle here. It's been incredibly successful.
How successful?
They have 36 million members now. And those members spend, on average, 3 times more than non-members.
3 times more again, just like the dual users.
Yeah, there's clearly a strong correlation between membership, engagement, and spending. It really locks in that loyalty.
But they mentioned it worked differently for delivery versus mobility, right?
Yeah. Yes, that was a really interesting point. They said it's been a huge hit for delivery. The benefits free delivery discounts are very tangible and drive immediate extra usage.
Makes sense for frequent food orderers.
Right. But it's been more challenging to get the same kind of traction with the mobility audience. The value proposition wasn't quite as clear or compelling for ride-hail users initially.
Why is that? What's the challenge with mobility users?
Well, think about surge pricing. That's a big factor in rides. How do you build a loyalty program around something that can be volatile like that?
Good point.
So to tackle this, they've introduced a new feature specifically for mobility members called Surge Savings.
Surge savings. How does that work?
Basically, it allows Uber One members to pay prices closer to the standard fare, even when surge pricing is active. It shields them somewhat from those high peak prices.
Ah, okay. That directly addresses a major pain point for riders.
Exactly. Surge is necessary for network reliability, getting more drivers out when demand is high, but it's obviously not popular. So this feature tries to mitigate that downside for loyal members.
That sounds like a really smart way to add value to the membership for riders.
They called it a spectacular product for driving membership growth and mobility. They see a lot of untapped potential there compared to delivery, where the membership is already quite mature.
Turning a negative into a membership perk. Clever.
Very clever. It improves the experience and makes the membership much stickier for that segment.
Okay, let's switch gears now. Away from the core platform and onto something much more future-focused. Autonomous vehicles. AVs.
Yeah, this was another area with a lot of updates.
They described Q2 as jam-packed for AV development. Sounds like things are really heating up.
Definitely accelerating. They expanded operating zones, for example, added areas in Austin with Waymo.
Right, the Google spinoff.
Yeah. And also in Abu Dhabi with a company called WeRide.
Okay, international expansion too.
Plus, a big one. An exclusive launch with Waymo in Atlanta. That's a significant step for that partnership.
Exclusive launch, so only available through their app there.
Seems like it, yeah. And beyond that, they listed a whole bunch of new or expanded partnerships. Baidu, Lucid, Nuro, Wave.
Wow, quite a list.
The message was clear. They're moving at Uber speed, as they put it, and plan to ramp up deployments significantly in the U.S. and internationally in the coming quarters.
Uber speed. So fast and aggressive.
That's the implication. Faster than maybe some people expected.
So how are they thinking about AVs overall? Is it still just experimental, or is it becoming real business?
It's an interesting balance. They acknowledge it's very, very early days for AVs overall. The tech is still maturing.
Right.
But at the same time, they are determined to be in the lead in terms of commercialization. They want to be the ones bringing it to market effectively.
So learning by doing, essentially.
Yeah.
Deploying even while the tech evolves.
Seems like it. And they shared some fascinating data on how the existing AVs are performing.
Oh, yeah. Like what?
The Waymo AVs in Austin and Atlanta, they're apparently busier than 99% of our human drivers based on trips per day.
99%. That's incredible utilization.
It really highlights the efficiency potential once these things scale up. They can just keep going in a way a human driver can't.
And what about customer reaction?
They mentioned a positive halo effect in Austin. People are apparently excited about the technology, which might actually boost overall platform use there.
Interesting. So it's not just about the AV trips themselves.
And it's not just Waymo either. They emphasize the whole ecosystem of partners. Mobility of Reed, VW, Pony, Momenta. It's a broad strategy.
Trying to source the tech from multiple players.
Right. The goal is just getting this product to market quickly because they see the consumer appeal and, of course, the potential long-term safety benefits.
Now, some of these partnerships, like Lucid and Nuro, seem to raise questions among analysts, particularly around the cost.
Yes, that definitely came up.
Was the concern that this signals trouble with the Waymo relationship, or that they're suddenly spending a lot of capital for a company that usually likes to be asset light?
Both points were raised. Is it diversification away from Waymo? Is it a shift towards a more capital-heavy model?
How did the company explain it? What's the rationale?
They framed it through their philosophy of being a supply-led company.
Meaning,
Meaning the more drivers, or in this case, autonomous vehicles they have on the platform, the better the service becomes for everyone. More availability, shorter wait times.
okay, so they need AV supply.
Exactly. So their strategy isn't necessarily to build the cars or the core AV tech themselves, but to invest strategically in both the software and hardware players to bring forward that supply onto their network faster.
So it's catalyst capital, essentially.
That's how they seem to view it. And they were quick to point out they have the financial capacity to do this.
Right, with the record cash flow we talked about earlier.
Yeah, they said they can afford to invest aggressively in AVs while also returning billions to shareholders through buybacks. They see it as a both-hand situation.
Okay, but what about the long-term financing? Are they going to own fleets of AVs?
Their view is that once the model is proven, once AVs like Waymo consistently show that high utilization and a path to profitability, then other financing will step in.
Like private equity or banks?
Exactly. They think third-party financing will become readily available once the economics are clear. So their initial investment is just to get things started, prove the concept on their platform.
But they admit AVs aren't profitable right now.
Oh yeah, they were clear about that. AVs lose money today. But that fits their history, right?
Yeah.
They invested heavily in delivery when it was loss-making to build scale and eventually made it profitable.
Right, the long game. Invest now for future scale and profitability.
That seems to be the playbook here too, a calculated bet.
What about bringing more car manufacturers, the OEMs, into the fold? And how do they see competition, especially from someone like Tesla?
They see AV software development accelerating thanks to better AI. So the focus is shifting a bit towards finding hardware platforms, the actual vehicles that can be built affordably at scale.
Because the current AVs are still very expensive.
Right. So talks with all major OEMs are happening, and they seem confident about signing more partners in the next couple of years.
What's their leverage in those talks?
Primarily the massive demand they bring from their platform, plus their strong balance sheet. They can offer volume and financial stability.
And Tesla. Are they worried about them?
They acknowledge Tesla's presence, but said their current autonomous deployments are still very, very small and haven't really moved the needle in key markets like SF or LA yet.
Interesting. So not seen as an immediate major threat on the ride-hailing side.
Doesn't seem like it currently. Their main point was that the overall market for AVs is going to be very, very big. They don't see a winner-take-all situation. They expect a whole panoply of models, different players, different approaches.
And they aim to be the...
That's the vision, to be the leading third-party platform where AV supply from various sources meets the huge consumer demand on their network.
Did they talk about how they'll partner? Like the different deal structures?
Yes. They outlined 3 main models they expect to see.
Okay.
First, the merchant model. Here, they'd pay the AV partner a fixed fee, like dollars per trip or dollars per day. The company takes the risk and reward of filling those AV hours on their network.
Which they think they can do well because of their demand.
Exactly. Second, the agency model. This is more like a revenue share, similar to how they partner with human drivers now. Both parties share in the upside based on market performance.
Okay, risk sharing there.
And third, the licensing model. In this case, the company, or maybe a financing partner, would actually own the vehicles. They'd then pay the AV tech company a license fee for the software, maybe monthly or per mile.
Owning the assets, that sounds different.
It does. But they think all 3 models will coexist over the next 5 years, depending on the partner. And intriguingly, they suggested that actually buying vehicles, like in the Neuralucid deal, could potentially lead to better economics for them in the long run.
Really? How?
Maybe through efficiencies of scale, collective purchasing power, deeper integration. It challenges the simple asset light is always best idea.
Fascinating. Okay, moving away from AVs, let's talk about growing the user base overall. Audience expansion.
Right, critical for continued growth.
They reported solid growth, 15% overall, and added 10 million monthly active platform consumers, MAPCs, in just the quarter.
Yeah, 10 million is a big number, even for them.
So the question is, how sustainable is that? Where are these new users coming from? Are they hitting a ceiling anywhere?
They laid out a pretty convincing case for why the growth is durable. It's coming from multiple angles.
Like what?
One is pushing lower-cost products in developing markets, like Moto, the two-wheeler service.
Oh,
That's doing $1.5 billion in bookings now and growing at 40%. It's an affordable entry point for many users.
tapping into a whole different segment.
Exactly. But at the same time, their premium options are also booming. Over $10 billion in bookings, 35% growth. And the reserve feature for pre-booking nicer rides is up 60%.
60%. Wow.
So they're hitting both ends of the spectrum, low cost and premium, and targeting different demographics.
How so?
They mention specific products for teens with safety features and also for older users, maybe focusing on simplicity.
Tailoring the product.
Right, and the key is that users often cross-pollinate. Someone starts with Moto, then maybe tries a regular ride for a special occasion or orders food. They get drawn into the ecosystem.
So the entry point doesn't have to be the final destination.
Exactly. But here's the killer stat for durability. They said even in their top 10 markets, only about 20% of adults are using the platform monthly.
Only 20%?
Yeah, which means, in their view, there's still a ton of audience left to capture, even in their most established areas. Huge runway left.
That really puts the growth potential in perspective. Okay, staying with the user experience, what about pricing? They mentioned prices easing a bit in mobility because insurance costs moderated.
Yes, and the impact was positive.
How did users respond?
Well, they see direct sensitivity. A $17 ride converts better than a $20 one, obviously.
Sure.
But they also measure a delayed benefit. Lower prices make it more likely someone comes back to the app days or weeks later. It builds loyalty over time.
Interesting. So it's not just about that one trip.
Right, and crucially, because this price drop was just them passing through their own cost savings on insurance.
So their costs went down too.
Exactly. So profit per ride is actually still up year over year. They're not sacrificing margins.
That's key. Cheaper rides for users, but still profitable for the company.
It's a win-win. And they said transaction growth picked up in July, so they're confident this will continue helping through Q3 and Q4.
Smart way to pass savings along. Okay, let's get into something a bit more conceptual they talked about. Externalizing technical capabilities and the barbell strategy. What's that all about?
Okay, the barbell strategy first. This applies mainly to U.S. mobility, but also delivery. It's about focusing on both ends of the market simultaneously.
The two ends of the barbell, low cost and premium.
Exactly. Low cost is things like Wait and Save or Uber Share, accepting some inconvenience for a lower price.
Right.
They see this as harder to execute profitably right now, but it's the bigger long-term opportunity in terms of total trips and market size. It's kind of a margin investment today.
Okay, invest now for future volume.
And the other end is premium. Reserve, nicer cars, Uber for business, which is growing over 30%.
And that's easier to make money on now.
Yeah, easier to execute on and higher near-term profit potential, they think. So they're pushing hard on both ends at the same time.
Got it. And this applies to delivery too.
Yep. Things like priority delivery versus standard or delayed delivery, giving users choices based on price and speed.
Makes sense. Okay, what about externalizing technical capabilities? That sounds intriguing.
This is about leveraging their core tech and infrastructure in new ways, often for other businesses.
Okay, like offering their tech to others.
Sort of. Think about Uber Eats. It provides restaurants with an audience and delivery fulfillment.
Right.
They've separated these, so now they have a high-margin advertising business where restaurants just pay to reach the audience, and they also have a direct business where they just provide the delivery logistics for businesses that already have their own customers, maybe through their own app.
So offering fulfillment as a standalone service.
Exactly. Another example, though not for profit, is sharing AV data collection capabilities to help partners get autonomous tech ready faster.
Yay.
But the really exciting one they mention is Uber AI solutions.
AI solutions, what does that involve?
Leveraging their nearly 9 million global earners, drivers, couriers as a workforce for AI tasks.
You mean drivers doing AI work?
Yeah. Things like data labeling, translation, map labeling, helping to tune algorithms, tasks that are essential for building and refining AI models.
Wow, that's unexpected. Using their gig workforce for AI development.
It's a fascinating way to leverage their core platform for work, extending it into the AI space. They sounded very bullish on this potential.
That's definitely thinking outside the box.
Oh.
Okay, finally, let's talk money. Specifically, returning money to shareholders. Big news on the share repurchase front.
Huge news. a new $20 billion share repurchase authorization.
20 billion. That's a massive number.
It really is. And importantly, that's on top of about $3 billion left from their previous authorization.
So $23 billion earmarked for buybacks going forward.
Roughly, yes, which is around 12% of their entire market cap. It's a very strong signal.
What was the message behind such a large authorization?
Extreme confidence in their cash generation and a clear commitment. The CFO said returning cash to shareholders is their #1 concern.
Number 1 concern.
Okay. And they have a track record now. They've been using about half their free cash flow for buybacks, and they plan to continue this as a multi-year plan.
So consistent buybacks expected.
Yes, active every quarter, but also opportunistic. They plan to be more aggressive if the market sees a meaningful dislocation, meaning if the stock price drops significantly.
Buying the dip, basically.
Essentially, yes, to maximize the value. And it ties back to a promise they made before to actually start reducing the number of outstanding shares.
Are they succeeding with that?
They are. Share count actually went down by 1% in Q2, and they expect that reduction to continue for the next couple of years.
So the buybacks are more than just offsetting employee stock issuance now.
That's the goal, and it seems to be happening. They did mention they still look at deals like the Trendyol Go acquisition, but it's about balancing that with this primary focus on returning capital.
A very clear message on capital allocation then.
It's very clear and very significant.
Wow, okay. What a tour through their recent performance and strategy. We covered a lot.
We really did.
From those record financials and the big COO appointment, aiming to unify mobility and delivery, to the deep dive into platform engagement, trying to convert users with things like Uber One and that new surge savings feature.
Right, the dual user strategy.
Exactly. Then the whole complex world of autonomous vehicles, partnerships, investments, the different business models.
Still early, but moving fast.
Yeah. And then broadening the audience with things like Moto and Premium, tweaking pricing, that barbell strategy, and even externalizing tech for things like AI.
And finally, the huge commitment to shareholder returns.
Absolutely. It paints a picture of a company firing on, well, many cylinders, but also making some really big bets on the future while rewarding shareholders now. We hope breaking it down like this gave you a much clearer picture than just reading the headlines.
Yeah, and maybe one final thought to leave you with. It's fascinating to watch how these huge tech platforms juggle things, isn't it?
How so?
Like, how do you balance pouring money into something really long-term and capital-intensive, like autonomous vehicles, while also keeping shareholders happy today with massive buybacks? It's a real strategic tightrope walk.
That's a great point. Growth versus returns, especially when the growth involves such uncertain future tech.
Exactly. And the other thing is that idea of leveraging their workforce for AI. It makes you think about the future of work and how these platforms might continue to evolve beyond their original purpose, using a global network of people not just for transport, but for building the next waves of technology. Something to chew on.
Definitely food for thought. A lot happening under the hood. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.